Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into things going on in the market, basically where we've come to in terms of sort of headwinds and tailwinds out there. And yet, given levels of valuation, I really want to focus on what an investor can do today to get ready for what will be at some point a pullback, right? So what could somebody be thinking about as the markets have been performing so well? And so let's jump into it. I guess to start, we've talked a little bit recently about some of the catalysts that might cause the market to move. So a good example, which we talked about in the last episode, was the Fed disappointing and maybe cutting rates less quickly or less deeply than investors are expecting. There could be other things like an external event, a cyber attack, anything could kind of shake the environment, a turn in earnings, a turn in consumer activity. So we're sort of all watching to see how the environment's holding up. There's a bit of a buzz right now that the consumer, which is a major part of GDP of the economy, is slowing down. So again, we're parsing all that data. So we have to kind of be ready right now. Admittedly, as we've talked about as well, we've had these tailwinds. Certainly artificial intelligence, the efficiency gains, both being experienced and anticipated, has built up a lot of optimism. And then as well, I would say just in general, profitability and earnings growth in companies has held up probably better than people might have expected. All that's, again, led to this idea that the markets have posted great returns. What comes with that when it happens quickly is elevated valuations. So, for example, if you look at the price-earnings ratio, PE ratio, that's the price to the earnings of a stock or an index, depending on what you're looking at. If that number gets high, then price is going up relative to the earnings. And that's sort of viewed as, markets could be richly valued, sometimes a phrase used, or elevated, or if dare I say overvalued. And so when we look at that metric anyway, and we compare it to the 10-year average, where we've come over the last 10 years, it's sitting over 26% above the normal 10-year average level. And, again, these tailwinds I mentioned, artificial intelligence, a little bit more growth, those are factors that sort of justify sort of a higher valuation, but in some ways only to a degree. So not to be market timing, we don't know when a pullback is going to occur, but just think of it as we should be ready. And we should be ready emotionally, but also if there are things we want to do in our current investment strategy or whatever, this is a good time to be thinking about it. So, just to maybe put a final point on some of the numbers, even though the S&P 500 fell 19% year-to-date through April 8th, that was the tariff hit, right? The worries about tariffs. It's recovered, and now we're up in very round numbers, 15% year-to-date. So that's a good year. In any event, let's get into some of these ideas. The first would be the following. Let's say somebody either has experienced an inflow of cash, or maybe they've been sitting out of the market and they're sitting there with some cash and they want to, quote unquote, put the money to work. That's the phrase used for, I want to build usually my equity exposure. Now, doing that when valuations are really elevated can put all that money, if you invest it right away, can put it to risk, right? And so what are the tools or techniques that people use to kind of mitigate some of that risk? And the classic one is called dollar cost averaging. It's kind of a simple concept, which is to say, look, if I've got a certain amount to put to work, I'm going to break it into equal parts in dollar value, and then I'm going to invest each part periodically. Could be monthly, could be quarterly, but I'm going to be disciplined about it. And so the term is called dollar cost averaging. And sometimes, people might say, well, do that over 3 months or 6 months. So we would say if you're putting money to work, if you have cash that you want to invest in the equity market, it's a particularly good time to use dollar cost averaging. And I would also say, given the uncertainty as to any timing of a pullback, that I would extend that horizon a little bit. And again, this is obviously every investor is different. You want to talk to your advisor, but I would say a 12 to 18 month horizon is reasonable. It sort of spreads that exposure development over time, gives a little bit more of a horizon for declines, pullbacks, and recoveries. And so anyway, that's sort of one concept, is if you have cash to put to work, dollar cost average. Now, on a somewhat related note, when the markets run as they have, an investor who has a specific weighting that they prefer. So the classic, of course, is the 60-40. An investor would want to, on average, have a 60% exposure to equities and a 40% exposure to bonds. And let's say an investor had that at the beginning of the year. Again, in very round numbers, if that was invested back in the beginning of the year and it just ran to today and experienced basically the index return, and I'm thinking the S&P 500 and let's say the muni bond market, the stocks have done better. And so the weight of that strategy today would be about 63% stocks, 37% bonds. So one is overweight stocks. And so in that particular case, I think this is a good time to do what's called rebalancing. Basically bring yourself back to the 60-40. And so it's a little bit of a de-risking. It's kind of coming back to your policy. It's celebrating the extra return you've gotten from stocks, but sort of reinforcing that you're going to take those extra returns and basically collectively get yourself back to your strategy. So rebalancing would be a good thing to do. Now, another thing that I've observed of late, just as I've interacted with clients, is people, go through time and they make decisions in life as to, for example, when they're going to stop working, when they're going to retire, how they're going to spend their money up to into the first part of retirement and then beyond. And one of the factors that people have to think about, and it's a little bit complicated, and you want to work with your advisor and do this in a way that is specific to you, but just in general, what happens is people will often want to de-risk. Maybe they've experienced a really good portfolio result, strategy result, as a result of the stronger equity markets, but now they're finding themselves wanting to maybe shift and be a little bit more conservative. So the industry term is, I want to de-risk my portfolio. And so that's sort of a different version of what we're talking about. It's a little bit of a shift. And yet, when markets are elevated, people don't think about it as much because they feel so good about the stock market going up. And yet this is, if you're going to do it, this is kind of a good time to do it. It's almost like celebrate the gains, knowing that there might be a pullback. Better to sort of take that money off the table. This is, again, another phrase that's used in the industry, sort of before that happens, right? And so, again, it's all very personal. And it's the same thing that typically is done incrementally, so sort of like the reverse of dollar cost averaging, where you say, hey, I'm going to slowly but surely de-risk my strategy. And so in this environment, you want to make sure, if you're thinking about doing that, to at least kick off that process. And so anyway, that's another concept, is de-risking, if it's in terms of your personal circumstance, something that you've been thinking about doing. Now, the last thing I want to get to, excuse me, is, well, actually, I'll say two things. One is, there are sometimes situations where investors are looking at the market and maybe they don't have exposure to certain investments that do really well. And there's almost like this disappointment or fear of missing out. And the block of stocks that has been in the news for a long time about that has been tagged the Magnificent Seven. So Google's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla, that cluster overall has done well. And so, the way to think about it is, gosh, if things are elevated, that cluster of stocks is at least a little bit elevated. And so when that happens, it may or may not be a great time to invest. And yet, if we see a pullback, sometimes recently when we've watched those pullbacks, those types of stocks have sort of pulled back more. You'd hear the phrase, they led the decline. And so it's not so much to say, oh, go buy something like this today, but more, there are certain strategies that will look more appealing after the market decline. And so you can talk to your advisor about what those things might be. If it's something that you had hoped to get invested in, but you haven't, it's really about looking across the different types of investments. And then if something ends up that is sort of fundamentally good, ends up declining more than other things, that might be a good time to build a position, basically. Now, the final thing I'll mention, which is a little bit more dramatic, is there are folks, investors, who are increasingly worried about a more severe outcome. So here, take, for example, a topic we've been talking a lot about is the fiscal trajectory of the U.S., meaning that we're building debt. We have deficits, we're building debt. And, unchecked, we could find ourselves in a circumstance where and this is years out, but still, where we have some economic challenges and probably as a result market challenges as the system is really strained by the higher levels of debt and the cost of that debt. And so just the concept that I'll mention and the phrase that we sometimes use is a quote-unquote black swan grouping of investments is the idea that you might want to start to allocate a little bit of money at least to things that will hold up and protect you a little bit in those more severe scenarios. And it's a personal decision. You should talk to your advisor. But, the things that kind of get introduced for that kind of circumstance, for example, might be precious metals. And it's just sort of historically been the case, not always, but that precious metals often will hold up well and in a stressful environment. Another is sort of the idea of hard assets or real assets. And so at a high level, commodities, things like that might be something to consider. And then if one is worried about the U.S., we've got sort of, all our investments in the U.S. dollar, if you will. If somebody's thinking about diversifying beyond that, you can look off border, right? Non-U.S. stocks potentially, or other currencies that are considered helpful. And again, I will reiterate that this whole concept is something that people are spending more time thinking about, but it's obviously a little bit complicated. And so the main message is, if this is something you're worried about, it's a good time to talk to your advisor and kind of dig into these types of potential opportunities. So anyway, that's what we wanted to cover. Again, we've generally been optimistic. We remain optimistic looking forward, but we do realize that the market can be volatile, and given levels of valuation, it would be pretty typical to see a little bit of a pullback here at some point. So while we're not market timers, getting ready for the pullback, thinking about issues like this, it's a good thing to do. And so we want to dedicate this episode to that. Thank you so much, and we'll talk to you on the next episode.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.